In 2001, Argentina defaulted on $132 billion in debt, the largest sovereign default in history at the time. Within weeks, people were breaking into supermarkets. The middle class was lining up at ATMs that had already run dry. The government froze bank accounts. Savings disappeared, not slowly, but overnight. And Argentina was not a small economy. It was the third largest in Latin America. Now imagine that happening to a country 10 times its size, or 20. That is not a hypothetical designed to scare you. That is the logical next question once you understand how connected the global financial system actually is, and how much of that connection most people have never thought about for even 5 minutes. So let's think about it now. When we say a country goes bankrupt, we need to be precise about what that means, because it is not the same as a company going bankrupt. A country does not disappear. It cannot be liquidated. There is no judge who shows up and sells the parliament building to pay off creditors. What actually happens is that a government declares it cannot or will not make scheduled payments on its debt. That moment is called a sovereign default, and the aftermath is where things get genuinely strange. The first thing that happens is the currency collapses, not weakens, collapses. Because the moment a government defaults, every investor holding that country's bonds, and there are always investors from dozens of countries holding those bonds, starts selling everything denominated in that currency as fast as possible. The currency loses purchasing power in days. Imports become unaffordable. Fuel prices spike. Food prices follow. And since most major economies import at least some percentage of their essential goods, the domestic population starts feeling the consequences before the government has even finished drafting its official statement. Now here is where it gets interesting and uncomfortable. Major country debt does not just sit quietly in one place. It is held by pension funds in Europe, insurance companies in Japan, sovereign wealth funds in the Gulf, and retail investors in the United States. When Greece nearly collapsed in 2010, a country whose economy represents roughly 2% of the European Union's total output, it triggered a crisis that threatened to bring down Spain, Italy, and Portugal simultaneously. Markets fell across 3 continents. Emergency summits were called. The International Monetary Fund flew in within weeks. Greece is a small economy. Now think about what happens if the country in question is a G20 member. The mechanism here is called contagion, and it works faster than any government can respond. When a major sovereign defaults, the immediate casualty is not that country's economy, it is trust. Every other country that borrowed money under similar conditions suddenly looks riskier. Interest rates on their debt rise automatically because investors now need a higher return to justify the risk. A country that was managing its debt fine last Tuesday is now struggling to refinance by Friday. This is not metaphor. This is how the bond market works in practice. And then there are the banks. Large commercial banks in Europe and North America typically hold significant exposure to emerging market sovereign debt. It is a core part of their portfolio strategy. When a major sovereign defaults, those banks take losses, sometimes severe losses, on assets they were treating as relatively safe. If those losses are large enough, credit freezes. Banks stop lending to each other because no one is sure who is holding what and how much of it just became worthless. The last time that happened at scale was 2008, and in 2008, the underlying asset was mortgage-backed securities. Sovereign debt is, in theory, supposed to be the safe version of that. There is a concept in finance called too big to fail. The idea that certain institutions are so deeply embedded in the system that allowing them to collapse would cause more damage than bailing them out.
Sovereign debt carries a similar logic. Certain countries are, in practice, too large to be cleanly defaulted on, not because they are well managed, but because the downstream consequences of their failure are too widely distributed. So, the IMF steps in, the World Bank steps in. Emergency loan packages get assembled over long weekends by people in suits who have not slept in 2 days. Austerity conditions get attached. The country's economic policy for the next decade is effectively written by creditors sitting in Washington and Brussels. This is what actually happens. Not a dramatic collapse, not a sudden reset, a slow administrative takeover dressed in the language of assistance. But assume for a moment that the country is large enough that even the IMF cannot fully backstop it. Assume the default is genuinely disorderly, meaning the government stops payments without a negotiated restructuring plan, the currency is in free fall, and capital is fleeing faster than any policy response can contain it. What then? Global supply chains, which are already fragile in ways that became obvious during 2020 and 2021, begin to break in specific places. If the defaulting country is a significant producer of commodities, oil, copper, agricultural output, rare earth minerals, the disruption is not just financial, it is physical. Things do not get produced, things do not get shipped. Companies that built their manufacturing models around access to those inputs start facing shortages with no obvious substitution. The geopolitical dimension is not separate from this. It is the same thing. Countries under severe economic stress make unpredictable decisions. They elect governments with unconventional views on international obligations. They nationalize foreign assets. They exit trade agreements. They become bargaining chips in larger geopolitical competitions between powers who want to extend credit in exchange for influence. The economy and the politics cannot be cleanly separated once a country hits genuine crisis. And here is the part that rarely makes it into the standard explanation. A sovereign default at scale does not just hurt the defaulting country. It creates a global argument about who was responsible and who should pay to fix it. Creditors blame the borrower for fiscal recklessness. The borrower blames the creditors for predatory lending. The IMF gets blamed by both sides simultaneously. Whatever settlement eventually emerges gets resented by everyone involved, and the next time a similar situation develops, because there is always a next time, both borrowers and lenders are operating under the memory of how badly the last one went, which produces its own set of distortions. Argentina defaulted again in 2014 and again in 2020. The global economy does not reset cleanly after a major sovereign default. It adjusts unevenly over years in ways that are almost impossible to trace back to the original event by the time they become visible. Certain investors become more conservative. Certain countries find credit more expensive for a generation. Certain supply chains relocate. Certain political parties that would not have existed otherwise start winning elections. The technical event, the missed payment, the default notice, the emergency summit, that is the part that makes the news. The actual consequences spread quietly, slowly, through a system that was always more fragile than it looked. So, the next time a major economy starts showing the early signals, rising debt to GDP ratios, currency pressure, political instability, creditors getting nervous, the question worth asking is not whether the system can absorb it. The question is, who in that system has already decided they cannot afford to find out?